Hey there. How you doing on the quarantine? I mean, let's be real, right? It's been a month here in Colorado and we have until the 26th. There's some information I want to share with you though that I have learned about mortgage forbearance programs and why they may not be all they're cracked up to be. What I'm here to tell you today is to be careful, because in the research that I've done, I was curious about how all this works, so I looked into it. And I want to share with you that unless you absolutely are down and out desperate, do not take advantage of the mortgage forbearance plan that's in effect right now under the CARES Act of COVID-19. So I want to introduce my guest, who is Andrew Levitt, and the name of his company I just love. It's called Pay It Forward Lending, PIFlending.com. And he answers questions that I had about this that I hope help you resolve any questions you may have too. Love ya. On the surface, this mortgage forbearance offering can sound very exciting and like a relief to people, right? But what I hear you saying, Andrew, is that proceed with caution and do not take advantage of this if at all possible. Is that correct? And why?
Correct. So the biggest thing that we have to look at when it comes to a mortgage payment forbearance is this isn't deferment, it isn't forgiveness. So in simple terms, let's say your mortgage is $1,500 a month. For most people in America, the mortgage or their rent is their largest expense in their monthly budget. So if you go ahead and apply for the forbearance, and so you miss, or you apply for it, right now they're approving 3 months automatically. So if you call your servicer, they'll say, great, we can put into forbearance for 3 months. So your mortgage is $1,500 a month. So those 3 months go by and you don't pay that $1,500. But when you get to month 4, 2 things are going to happen. One is they're going to say, well, we can go ahead and approve you for additional forbearance and you can go another 3 months. Or 2, they're going to say, great, you owe us the last 3 payments and this month's payment. That's going to be a total of $6,000. You can see that it adds up pretty quick at that point. If you haven't been able to make the payment for the last 3 months due to loss of income or job loss or something to that extent, well, chances are you're not going to have $6,000 laying around to go ahead and get the mortgage caught up. So if they don't approve you for the additional forbearance, that's when you're going to go looking into doing either a loan modification or possible foreclosure, and it's going to be at the lender's discretion of which direction they want to go. And so what criteria is going to be required, right? So maybe you applied for forbearance, but the dates of your employment that got lost, then does it meet the criteria? So they're not going to let you do a loan modification. Who knows? And so those haven't really been published yet, and they're going to vary from servicer to servicer. But nonetheless, the reason I say proceed with caution is if you have that ability to make that payment, you don't even have to get to one of those 2 roles to where you're looking at a loan modification or a foreclosure possibly. The biggest thing is what's been promoted with the forbearance is that there's not going to be any negative remarks on your credit report as far as late payments. However, all lenders at this point have asked when we're doing a loan, has the client applied for the forbearance option at all on the mortgage? If they have, they are ineligible to refinance and purchase. We're likely going to see that question come up on more financial applications outside of mortgage. When you apply for that new car, that new business loan, the next professional license, chances are that question is going to pop up down the road. Or while no negative remarks will show on your credit report as a late payment, what all creditors are doing currently, car loans, credit cards, mortgages, they do add comments to your credit report. Loan was affected by a disaster. So it will be on your credit report for 7 to 10 years. That particular trade line, it was exercised to use the forbearance option. So it's not a negative remark, but it's enough for the lender to look at and say, oh, okay, well, that applied to them. Here's what we're going to set forth of criteria for your new loan you're applying for.
What often happens in times of duress like this, especially with financial pressures coming from so many different angles, a lot of times people who fall into these traps are the people who are the least able to dig themselves out of it. Those who are living paycheck to paycheck, living on the edge, and who may see this as an opportunity to stockpile and, maybe I'll pay off some stuff if I don't have to pay my mortgage for a few months. What I hear you saying is, at all costs, do not do that. Don't think it's your chance to pay off your credit card debt or go buy a big screen TV, because the fine print is going to come back to bite you. What do people need to be aware of when it comes to that loan modification you started to tell us more about?
So, just let's go down memory lane. Let's think of 2008 economy crash. A lot of that was done to fraudulent loans, which we can get into the whole recession then versus now. They're two totally different animals. But nonetheless, let's just look at the 2008 picture. Many people applied for loan modification. There's a very good chance anyone watching this video knew somebody that had a short sale, had a foreclosure, that walked away. There's a very good chance that anyone watching this video also knew someone that said, I tried to work with the banks. I tried to go through the loan modification. I sent in my documents constantly. I checked with them weekly. I checked with them monthly. I did it for a year and a half. And all I got was a compartmentalized structure of the bank of people who didn't know what they were doing or didn't really care, for lack of better words. And I never was able to get the short sale approved. So I said, screw it. I walked away. Or I took a cash for keys offer, or just didn't deal with it at all and stayed in the house until they did come and kick me out. Most people in America know somebody that happened to or dealt with it. And so the reason I bring that up is, let's go current day. For the people that are going to go doing the loan modification now, it's the same system, it's the same banks, it's the same call centers. Maybe it's even a little bit worse now with the call centers being all split up because of COVID. And so now you're going to try and reapply for it again, along with 20-30% of the rest of Americans that are doing it. And not on top of just being already a hard process as it is, the documents they ask for are not easy to understand. The criteria they set on this is not easy to understand. And their reply from the bank is going to be, well, you can figure this out on your own, or you can go to a company that helps with loan modifications, or you can go get an attorney. Well, if you haven't been able to make your mortgage payment for the last 6 months, chances are you don't have $4,000 or $5,000 laying around to pay an attorney.
Mm-hmm.
Okay, so now you're trying to do this on your own. You're stuck with having to resend everything, trying to understand on your own. At what point do you just get frustrated and say no more and give up? And that's what happened in 2008. It will happen again this time. It's not going to happen as with excess housing supply as it did in 08, but nonetheless, loan mods are not easy. You are modifying a recorded document against your house. It's not a simple task.
You have no control over the terms of it.
You essentially are negotiating with the lender, but you have no control at the criteria they set forth. It's their loan, it's their bank, they're going to offer. Obviously, you can ask. That's what the whole thing is that you go back and forth countering with each other. But it's, a great analogy to use is if you get into an auto accident, right? You call the insurance company, they shut you down quick, but the attorney calls once and instantly it's a different conversation. Well, let's keep that in mind. It's the same process. You're going to call these mortgage companies and they are going to try and recover as much as they can financially. They're not on your side. They're not going to be there to help you. At the end of the day, if you, as a consumer, doesn't make their payment, they still have to make their payment to the bondholders. So they need to recover as much as they can. And while they'll have the bubbly personality on the phone, it's not their responsibility to help you, especially if your property has equity into it. It's hard to speculate what the bank's perspective is going to be, but they're not there to help. They're not the attorney for you. They're not on your side.
Mm-hmm. Okay.
You signed a contract, you have to abide by it. And that's how the banks are going to look at it.
All right. What other things do people need to look out for and be aware of at this time if they're on the fence and thinking that this might be for them?
As far as doing that, if they're on the fence about thinking of doing the payment forbearance?
Yes. If they think that they are tempted to do it or feel like it's their only option.
If it's your only option, chances are you can prove loss of income, you can prove loss of employment, you can prove hardship and distress, and you're going to want to document that very well. Because when you get to the loan modification process, which is going to be probably the end result, if that bank has that criteria set forth that you have to document and prove it, well, then you'll have it. If it's truly your only option, you're going to be able to document it was your only option. And when I say document, This is things such as an email from your employer that your job's been eliminated or your position's been eliminated or you've been laid off, something in writing tangible that shows that you were laid off. Obviously applying for unemployment and having the unemployment forms that go along with that, the payroll deposits from unemployment. So you're just going to want to keep really good records at this point. And so when you get to the point where you're dealing with that loan modification, because loan modifications aren't all that bad if they go according to plan. So when that bank gives you that criteria, and if you can meet it and fill out all the documentation, well, then they're going to move those payments to the end of the loan. And that's what a lot of people are hearing is that, well, what happens? They'll just move them to the end of the loan. That's most likely what will happen, but you're going to have to prove it. And again, what that exact criteria is now, we don't know. We won't know until you're actually in the middle of it.
Okay. So part of the importance of being, good record keeping and kind of staying on top of what's required is to make sure that when the time comes, you can hit the ground running and hopefully be ahead of the curve, as all of these entities are going to be inundated and already are, as you point out. You said you've been crazy busy, right?
Right. And keep in mind, let's say that you don't document everything. The lender could have criteria that says if you can't document it, too bad. We're going to foreclose. And that's the big risk here is we don't know that criteria, and it's going to be different from bank to bank.
So the best tip is pay your mortgage if you can.
If you can, yeah. And that's the biggest piece is just, our biggest tip is if you can make it, use what the stimulus is passing, use what you have in reserves and make that payment until you can. If you still have your employment intact, you can do a refinance. We are at the lowest rates in history. You can also do a cash out refinance to where you pull out equity from your house and consolidate all your debt into your mortgage. So if you have your employment still intact, you want to consolidate some debt, you can definitely do that, or you can lower the payment. The cool part is if you do a refinance, you're able to defer 2 payments just by the nature of the transaction. So as an example, if you close your loan in May, a May payment and a June payment's not going to be required. So you get that 2-month break or deferment. Costs are low right now. Rates are the lowest in US history it's ever happened. So definitely take advantage of that. If you do have reserves and you do have income handy, if there was something that you wanted to purchase right now, things are cheap.
What's the best way for people to reach out?
Yeah, so just call our office, ask for Andrew. The front desk will set up a time for me to give you a call. Our main line is 702-800-7409. Just call the main line. Reception will set you up with a time for myself to give you a call. We'll answer any questions you have.
All right, Andrew, love it. Thank you so much. And if people could use your guidance, they can give you a call.
Awesome. Well, thanks for taking the time, and I appreciate your invite to do this.
My pleasure. Thank you.
Okay. Catch you later.
All right.